I'm going to moderate. How's that? How's that? So
Perfect. That's
uh,
awesome.
I'm on a different setup, so I can't retweet. So if you guys want to retweet, go for it. If not, we'll get started in just a second. We can just listen to the great music. I say we just use copywritten music, get deplatformed for a little bit, but at least we go out with a splash with like Rolling Stones or something.
That would be good. Rather than just these kind of generic funk beats.
Yeah, getting by the way, getting a cease and desist letter from somebody. So let's say Chapel Rowan will do someone's recent. We could actually that would get us a lot of publicity. So maybe we should think about that. But let's see. It is Wednesday, and this is Wall Street Beats, and we're going to kick it off. Why not? Why not start with the beginning? We have Jeff Mackey, Robert Morrison. I'm David Maris. We're going to talk about a little bit about healthcare later on, but I know Robert has a company that he wanted to talk about. Jeff, I'm sure we're going to talk about some exciting names that have either spiked 10%. Your group always spikes 10% or drops 20%. It's always like it's a lot of drama always with your group. But
Yeah.
Robert, you had a small cap name that you were looking at that you're going to revisit today. Which company is that?
Yes, it's my one of my last remaining semiconductor longs in the portfolio called Silicon Motion. And last year or year in 24, I guess it had gone from 85 down to 50. It had gotten too cheap to be true if the business was going to grow the way they said it was going to grow very publicly, and it's starting to play out that way. So last night the company reported a solid quarter. It wasn't phenomenal. What sort of blew away the street was the outlook for the next quarter, which was a $300 million revenue forecast versus a $230 million street consensus. Um, so that's a 25% beat or raise. That's not bad these days for a company we bought at less than 10 times earnings last year. Um, the year is obsolete as well, which was 1.06 billion, but they said they would grow sequentially every quarter. So if you give them 3 to 4 or 5% sequential growth, because you wouldn't say that unless you had that sort of booked, in your mind. If you're going to grow 1 or 2% sequentially, you can't say that because you don't know. But if you're going to grow sequentially at 4 or 5%, they're going to do about 1.3 billion, and the street was $1 billion give or take. So this year's growth is going to be 45%. It's all organic, and on the call, and I don't know if the CEO understood what he was saying, but he said that hopefully we can grow faster in 2027, meaning versus calendar 2026. So if he does better than 46% revenue growth next year that he's budgeting for this year, I would be very impressed. I think that's nowhere near in the stock. So I had a Silicon Motion. It's about 130 today. It's up $10 on the news as it should be, all time high. As it should be. The business will be at a record this year by a lot, and it'll be a lot bigger next year. So they're benefiting from AI. They're benefiting from secular changes in their business. They make controller chips that manage the memory and storage in NAND flash. So the NAND flash is like a tank, and they sort of run the valves that control the flow of water in and out of the tank. That's what a NAND controller does. The NAND flash is just a dumb tank. It just stores data. It doesn't process anything, doesn't correct itself. It doesn't know where to store it in this series of tanks. So that's what their product does. So it's a critical piece of technology, and there's a tremendous amount of demand for memory and storage because of the boom in AI and the data centers. So they're just, they're not directly involved in GPUs and CPUs like Nvidia, but they're very much in the ecosystem. Nvidia's become a client recently, and they think they could turn them into a very large client in the next 2 to 3 years. So stock's still cheap, and it has a good chart if you believe my numbers at 100. Again, we're in the low 50s from a year and a half ago, but I still think the stock is reasonably priced. The street was like, $4, $5, and $6 in earnings starting this year. I was 6, 8, and 10. Said it publicly on this show a couple of times if they execute it. So I was 50% higher than Wall Street's estimate for the company for 2 to 3 years. So if I think they'll make $6 this year now, it looks like. And then next year, if they grow faster than 45% in sales, even if they grow 30, 20, or 30, they should grow to $8 in earnings with flat margins. And then the following year, it's even, $10. So in a year now, we'll be looking at 8 and 10 being this year and next year. So the stock's $130. So if you think 130 divided by 10 is expensive or fairly priced, you don't understand how semiconductor companies trade. So I think if
So what do you so
Go
so
ahead.
clearly you don't. I was going to say clearly you don't think that there's risk to the numbers because your numbers were higher. But what could go wrong? Like where do you think this is? What could change that would make this okay? Well, look, we need to come back and reset our numbers because that sounds like the only thing that could really derail a story that's beating numbers by so much.
Well, there's two risks: too hot or too cold. So if the world is just right, porridge is just right, they're going to boom. So too hot could be a problem. If starts to get too short. So what people are doing with memory is they're directing it all to the enterprise customers, the hyperscalers, and it's going to cause a problem for PCs and cell phones. And for now, 98% of their revenue is PC and cell phones and cars and Internet of Things devices. That's where their chips go. So only in 2 years will enterprise be maybe 15% of the company's revenues. But it's an untapped market. It's bigger than the consumer market. So, and they're just getting into it, which is why the growth could be so strong. But a lot of the companies that make the controllers for PCs and cell phones are the companies that make the NAND flash, like Micron and Western Digital and Samsung. And they're abandoning the markets for PCs and cell phones. So they're just giving the market to this company, which is what I expected. So
All right.
if NAND gets too short and you can't build PCs and cell phones, this company has a risk, right? So that means the market got too hot. If the market gets too cold and AI implodes, I suspect as a stock it would suffer with Micron and Seagate and Western Digital and all the storage memory stocks. But it wouldn't kill the business because they would still keep the business in PCs and cell phones that their former vendors and competitors used to supply themselves. So that business would be there, and there's still going to be enterprise business that it's going to be, that they're not going to lose it if the AI thing implodes because they never had it in the first place. So if there's a global recession and a down cycle because the AI business implodes, the build out and all that is delayed or has a problem, then there would be a risk there. But it's hard to see how they cannot grow significantly in the next 2 to 3 years. These products have design cycles. You get designed into products, and they usually last 2 years, 3 years, 4 years. The PC cycle is 2 years usually. The cell phone business might be 1 to 2, but then all their other products are 3, 4, 5 year design wins. So it's hard to see what the risk is. The biggest risk for most shareholders in a situation like this is saying, "Oh, I tripled my money or doubled my money. I'm going to sell too early," because they can't imagine the numbers. If you followed the street, you could have. I would say if all I thought they were going to do was make 4, 5, and 6, I'd sell the stock today at 130 maybe. but I'm 6, 8, and 10, and 10's a lot freaking higher than 6. So if I sell with a $10 estimate, I've got to be a knucklehead, because if I'm gonna stock could double again from here if they make $10. Why not a 30 PE for a 40% grower on a $10 estimate in a year and a half, right? So that's how I'm thinking. So the biggest risk is people, they do my numbers, and myself or other people sell because we've made 100 or 150% our money.
All right. They're SIMO. Is that the ticker?
SIMO is the ticker. Yes, it is.
All right. All
So
right.
it's
Well,
very,
we'll keep an eye on that.
I haven't seen a company with a 30 or 40% rev. There's companies, that industrial companies that sell into electricity, generation market, growing 9%, trading at 40 times earnings right now. One of them I talked about on the show, Powell Industries, that I circled 2 different times and never bought at 150, and today it's 500. So again, this company is, the obvious biggest risk that I didn't mention is China mobilizes the fleet.
Why is that? Why is that a giant risk? I mean, other than the geopolitical risk.
Right, because this is a Taiwanese company.
Okay, so you mean mobilizes the fleet against Taiwan? I didn't know which
Yes,
which
yes,
target you're talking about.
yes. Well, that's the only target they have explicitly in their formal military policy. They
Yeah.
actually have a stated military of goal by 2028 being capable of taking Taiwan by force, by overwhelming force. I have the document that proves it. I mean, it's out in the public. It's not. I read the document.
Yeah.
So,
Well,
but that's
getting fuel to
we have bigger
getting
problems
fuel
around
to
the
all
world.
those troops is a problem, but
Yeah, we have a bigger problem. The whole world will have a problem if Taiwan, gets us, faces the Chinese armada. So
well, don't worry about those things. Look at the email drops. Be distracted. Don't care about those things. Be distracted by that and Grammy fashions and things like that. Don't focus on the important things. Is what we're supposed to be doing. I hear you.
Nvidia
That's I guess that is. I guess that we
problem.
have a bigger risk if that happens. We have a much bigger risk than Silicon Motion. But
You are
um,
correct. Yes.
alrighty, well, Jeff, what do you have for us today? I mentioned in the pre that your stocks tend to be pretty volatile. Is it earnings outlook or earnings report or somebody else in trouble? Oh, we can't. I can't hear you,
Yeah, you're muted. Or
Jeff. You're muted.
Now, can you hear me now?
yes.
Now we can hear you.
Now you can hear me. That's good. Well, I just said something incredibly witty, and you guys can just re-record it
Sorry, we
and
missed
edit it
it.
in later. Yeah, that's great. Now it's. I've got there's less drama here, but there's actually kind of a cheap company that's regaining its mojo a little bit, and that's Target, my hometown company. But it's just out of nowhere. Or suddenly that chart looks pretty good. They've got a ton of just low hanging fruit. I mean, it's a story really where things couldn't go much worse than they have been going for the last 3-4 years out there. And I just the box stores are on fire. If you look at Costco, Walmart, Target, they're screaming higher this year. Target's up 17% already. It's February 4th. This would be the first year of gains in God knows how long. But they've got a new CEO coming in, and I think they're just gonna shuffle the deck. You walk through the stores themselves, and there's just so many things they can do that are just basic blocking and tackling. And when you look at Walmart going over $1 trillion market cap, you know, Target, that used to be kind of a yin yang relationship. It used to be they're not even related anymore. Target doesn't deserve to breathe the same airspace, but it's the discrepancy in kind of the valuations of these things and the near term growth outlook. It Target can catch up a little bit. They can get to 15 times, they can get to 20 times relatively easily, just with some fundamental retail stuff. They got to get out of social issues. They've got to get back to just serving all the customers in an upfront basis and creating friendly, safe stores to shop. Sounds super easy, and in fact is. Um, I would like to see, frankly, the company kind of look into other options than being home based in Minnesota, which is not a great place to do business right now. I don't think that's on the table, but I think everything should be when you got a new guy coming in. And I just feel like this is a company that not a lot has to go right for it to start catching up. And I feel like the box stores are having kind of a moment. Staples are having kind of a moment. I know Target's discretionary, but that's more a matter of how they kind of sort these sectoring labels out than it is what the company does itself. So I'm keeping my eye on them. I'm long the company already. I'm long actually all three of those. And I like them going into Amazon's number tomorrow. I think Amazon is going to say good things about retail. I don't really know what they'll say about AWS. That's obviously going to be what that stock trades off. But if you kind of dig a little deeper and look into what's going on with Amazon retail, you see that business kind of stabilizing, still coming off the tariff lows. And of those names, I think Target finally breaking above sort of this trench that it's been stuck in for the last 9-10 months. Yeah, it's just been quarter after quarter of disappointment there. Not a lot has to go right. And I think just some proactivity would buy the new CEO a little time. I mean, you guys have probably heard me say it before. I love a new CEO with a plan. I think if you come out and you just say smart things, particularly in a situation that's not seen as particular turnaround, Target's lacked a real sense of urgency over the last few years in terms of improving operations. But a CEO with a plan can usually get you about 3/4 of kind of, shall we say, grace from the analyst community when it comes to your estimates. In other words, Target, when they come out and announce what they think they're going to earn this year, people are expecting them to take a hacksaw to it. They're going to have to spend a little bit of money to make this stores work better, but it'll be money well spent. If the plan makes sense, it won't matter at all. And you'll see this thing kind of just the stock will continue to work.
Yeah, so that's what I was going to ask you, and I guess you kind of framed it perfectly, which is the stock's working, and if people were really afraid that he's going to kitchen sink it, then the stock wouldn't be doing this. People would, institutional holders would be like, "Hey, I'm going to wait till he comes out with that new earnings guidance." And so, I mean, is that the right read of it? Is like, hey, people are already
Yeah,
expecting that.
it's priced like at Sears right now. It's gone down from 280 to 100, and they may in fact be Sears, but they won't die for the same reasons. They won't die because they didn't try anymore. Sears was just gutted over the period of about a decade and a half by Eddie Lampert, who just sold it off for parts and moved half of them to Eddie Lampert Offshore Industries or something. That's not what's going to happen to Target. They'll go down swinging, and so they've already announced that they're going to spend more this year than last. You can get into liquidity problems, but again, there's a lot of stuff they can do just simply better in those stores. And, it starts with just respecting the customer a little bit, just blocking and tackling. And so they are going to take down their earnings estimates. They are going to spend a lot of money, but the stores need a refresh. And, these are good merchants. And still, traditionally, Target didn't forget how to retail. They just forgot how to kind of present themselves in public. And so, it could be the case that Wall Street, when they first hired an insider, the stock went down 10 points almost immediately because they were hoping someone from the outside would come in. They still have enough talent at the executive level. They just had kind of a mission creep. And if they just get back to doing what they should be doing, which is, again, giving customers just a little more than you'd expect from a discount store, there's some upside there.
Mhm. So you mentioned you own the three. So was that the Staples, Walmart, and Target? That was the three that you
That's
meant?
Costco, Walmart, and Target. I own all three. And so I was I felt like I trapped Walmart long for the longest time. That finally broke out, and now all of a sudden I feel like a savvy, patient investor. But it's Costco. I think goes back up over 1,000. That got pretty much snot lockered over the end of last year. But you're seeing a nice bounce there, and they'll report tonight. It's those two are pretty expensive for where they're trading, but that's because they're both excellent operators. Target has trades at a huge discount to the other big boxes because they have not been good operators for about probably 5-6 years. I think they can improve.
Okay, so one last question before we go, and this is totally, I don't want to say off topic. I mean, you should, you're good at this sort of thing. Having to do with the Super Bowl. We're a week out from the Super Bowl, and I know some people who are kind of more retail traders, maybe swing traders, they look at ads and like, oh, this is a great ad. You want to be long this because it's going to get so much publicity. Does that actually ever have a blip on operations, or is it just around sentiment? Is that something that's worth trading, or would you be like, that's, and I know that's not what you do, but is that sort of the most dangerous thing you can do?
Yeah, you don't want to. It's a really expensive and low bang for the buck type of experience. It's more based on sort of 10 years ago, 15 years ago, you couldn't see every single ad before the Super Bowl came out. And so you'd actually be surprised the nation, you had this monocultural moment where you would see these big commercial reveals and it was incredible. E-Trade did a nice job, but that was 20 odd years ago with the babies that were trading and stuff. It's at this point, all the ads leak in advance, and you really don't get that much bang for the buck. It's Levi's is coming out with a bunch of ads. I don't know what they're going to say about blue jeans. The game's being played at Levi's Stadium. They're not gonna knock anyone's socks off with what they say, and denim sales are not going to spike 18% because of Levi's ad.
Alrighty. Well, we're running up on the time, so I'm going to call it here. But I would ask Robert Marson what he thought of the latest Bad Bunny album, but we don't have time. And
The name
uh,
says it all. Yeah,
well,
we're running a little quick here. 22. Does Walmart or Costco ever get to a valuation that forces you to sell? Walmart's 40 times earnings, Costco is 50 or 60 or some crazy number, or do you just figure wait till the chart breaks down and use technicals as a sell message?
I've been there for a while in these things, and you're gonna have to just kind of put up with it. It's I'm giving the management the benefit of the doubt and just my patience. They've earned a lot of patience for me. I think Walmart has gone next level in terms of putting their tech to work, and I feel like they're both, particularly Walmart, has a real chance to extend their margins, which is a huge deal with the revenue base that they have, and that's I think the story of Amazon, why they're going into retail more. But these are companies that to your point before, they're not making chips, but they sure benefit from AI. They benefit from robotics. They benefit from automation because it just makes it so much cheaper to run those stores. You order something from Amazon now, it doesn't get touched by a human being until the delivery guy drops it off at your door, and that's about a half an hour later. So it's that drives the margin at 5%, 4% net margin business. You put that up a few points, and man, all of a sudden you're talking about real money between those three
Yeah,
companies. So that's over $1 trillion of revenue. So yeah, it doesn't take much margin to get them to be able to grow into those multiples
I think Walmart only makes 2 or 3% net margins. If
on a
I
net
remember.
basis. Yeah, when you get down to the end of it, that's about what they make. So it's
Well, going from two to
that's the
three is
good
a
news
big
and the
move.
bad news.
3.5. Yeah, if they go from 2.5 to 3.5, that's a big move in margin. Yep.
I'm not. They're obviously lagging in terms of what Amazon's doing behind the scenes on the factory levels, but there's this new store in Amazon's building in Orland Park, which is right outside Chicago, kind of a main drag for retail. That's going to be sort of a hybrid model for fulfillment and distribution. It's going to be a store and a distribution center. That's what Walmart's doing right now. It's a big amount for Walmart to spend to start automating those back rooms, but a reallocation of those huge 220,000 square foot stores into to you just have kind of a quarter of it, an eighth of it be just pure fulfillment center. You automate that, and it's a really efficient model, and people are willing to pay more for delivery. And they've all gotten so great at getting to people's houses. 90% of the country lives within 10 miles of a Walmart, which is a stat that never gets boring to me. Their ability to get that good out to people's houses is just incredible. They're delivering stuff in about 3 hours and something like 50% of the cases. It's they're fast, they're good, people will pay for it, and there's room for them to both take share. And again, if they can lever that margin up a little bit, it's not bad.
All right, thank you.
But yeah, absolutely.
Well, since Robert, you did remind me, we do have a couple extra minutes. I'll just be very quick on Novo, Lilly, Pfizer, the kind of the biggies of healthcare. But want to talk winners and losers? You just look at Lilly and you look at Novo, and you can see winner slash loser. Lilly has the better product; it's taking share. That's what's happening. So they reported a massive, massive beat, and their guidance is incredibly high. Now, I'd be a little bit concerned about meeting that guidance. It doesn't seem like it has a lot of room for the upside. Now, large cap drug companies don't usually make mistakes like that. Lilly has in the past 2 years made that mistake a couple times. So if I'm going to say any company is capable of making that mistake of being a little bit overly aggressive, it could be Lilly, but they really are on just such a winning streak with their pipeline, with the execution on the weight loss drugs. It's really outstanding to see. Novo's messed up on a number of different areas. Today they came out, or yesterday they came out and pre-announced that, hey, tariffs are having an issue. They didn't come out and say, look, market share is having an issue. Really, that's really the thing, that someone has a slightly more effective product, and in weight loss, that makes a big difference. Now they have a new oral weight loss drug, and that's actually taking a lot of share too. So, but it's not from that last quarter. So their guidance, I think, is conservative. Lilly's guidance is aggressive. Novo came out and said we're going to pre-announce and tell you that things. But they also today announced the start of their buyback, a massive buyback. So I don't want to read too much into buybacks because management teams, that's like a lever they pull to show that they're confident even if things don't look great. So there's not a great history of management buybacks being a wonderful indication of that, oh, things are massively undervalued. Um, but you could buy a cheap Novo, which is not going away, which does have a good pipeline, and risk it because you're buying what is currently considered a loser. And most value investors, that's what they're looking for. When you pre-announce, it's going to take a few days before that stabilizes. So I doubt that anybody's going to rush into it today. Or you could buy a winner that's way expensive. So that's really the two choices on the weight loss side. Or you could buy like a dark horse, like an Amgen that's working in weight loss that no one knows if they're going to have a big product, but that stock keeps going up every day on the idea that it might. So let's leave it at that. I mean, Pfizer came out with weak guidance. That could be conservative too. Really good yield. It's Pfizer, so it's a public utility of healthcare. Nothing. There are a lot of people who are within healthcare who are short that stock, thinking that they just don't have anything that's all that compelling. They're late to the market on the GLP-1s. They have a combination product, but it might not just be enough. So 2026 is still a little bit focused on weight loss drugs. I think we're going to be for a while. One of the big differences in the Lilly and the Novo guidance is that Lilly's assuming that mid-year Medicare starts to cover these drugs. Novo said they expect it in 2027. So who's closer to the thinking of the government? I don't know. If I were betting, and you wanted to have a somewhat okay chance for an election, you'd be pulling every lever you can and giving people super cheap weight loss drugs mid-year right before an election might be an idea. Not saying that those things are tied, but it wouldn't surprise me that those things are tied. Um, with that, any parting thoughts, or should we call it?
I'm good.
Jeff, Robert?
I think we're good. Watch Costco tonight. Let's see if they can put up another better than expected or same store sales number.
Go Costco. All right, guys. Thanks.
Yeah.
Thank you, these guys.
Bye, everybody. See you, Jen. Thanks.